Good day and welcome to another episode of Market Watch. Today I have with me Indika De Silva, the Assistant Vice President for NDB Wealth Management. Hi Indika and welcome to the show.
My pleasure. Thank you for having me, Ranaka.
Lovely, Indika. Indika, it's a very exciting time as well in the market, and I'm very happy that you're here, especially talking about the market, the equity market to the money markets. I wanted to give the viewers a fund manager's perspectives on the market. So, Indika, if I get to it, how would you define the current macro environment for an investor currently, Indika?
Well, the year 2017 also has been a year of volatility, if you look at it, for many reasons. The first 6 months of the year, the entire country went through a drought, which was followed by floods, one of the worst in the history of the country. If you look at the first quarter GDP results, which were released, you will see a dip in growth.
Yeah.
And I reckon we'll see a similar trend coming in the second and third quarters as well. If you look at it in a more global perspective, the oil imports, which is the highest import component of our country, oil prices have increased by, say, around more than 60% during the first quarter of 2017 compared to 2016. And on top of that, because of the drought, we had to import more volume to generate power.
Yeah.
So things like that, and also the increases in interest rates in the US also may have had an impact for volatility.
Yeah.
That took place during the first two quarters. And also I would like to bring into your notice the introduction of the new Inland Revenue Act.
Yes.
So with changes like that, you would see the current tax rates changing, which may have further implications on our macroeconomy and capital markets.
Right. So, in overall, if I put it, Indika, we had especially with the the weather effects and also the external factors like the US increasing rates. There was it's a bit of a volatile. I beg your pardon. It's quite a volatile time for the markets in Sri Lanka, I believe.
Yeah.
Right. So, Indika, in that context, as managing an equity portfolio, how would you how would you manage an equity portfolio within this context, and what are the risks, the challenges, and the opportunities that we might see in the market?
Well, I believe as a fund manager, managing an equity portfolio, stock portfolio would always be involved with risk, challenges, and always it would give you an opportunity. Well, it depends on each investor. Maybe you could take it the stock market. Maybe you can select few stocks and look at it as is, or maybe you can take a holistic view and look at the entire market.
Yeah.
Say if the investor does not want to be in the stock market or does not want any exposure to the stock market, maybe you could stay out of it.
Right.
Or maybe the investor has the risk appetite so that he would want to select a couple of stocks and maybe just be there in the market. But if you look at the stock market itself,
Yeah.
it's a risky business.
Yeah.
And as a result, you may be able to enjoy high returns as well.
Right.
For example, let's take 2017. The first 3 months, ASPI declined by around 2.6%, if I'm not mistaken.
Yes.
And the next 3 months yielded returns about 11%.
Yeah.
That shows you the volatility embedded in the equity market.
Yes.
So it always comes with risk and challenges, but if you play it right, you always will be presented with opportunities.
Definitely. So, in terms of that, can we be more specific on the opportunity? Do we see any sectors or any specific areas that we should be looking at, Indika, in this kind of environment? In your perspective, what do you see?
Well, Ranuka, I think as a fund manager coming from NDB Wealth, we actually have a house view that the Sri Lankan market is too small to sectorize.
Right.
So what we believe in is that you have to be more, you have to take a more active role in your stock selection and in your asset allocation.
Right.
So within the equity market, if you take, we concentrate more on selecting the right stocks for our investors, which could give them a higher return compared to the benchmark, right? If you go by the sector, for example, let's say the construction sector is expected to perform well in 2017.
Yes.
And you might overweight the construction sector by investing more on the particular sector. But rather than doing that, we would select one or two best companies from that particular sector and overweight on those particular stocks.
Right.
On the other hand, you take a sector which is not expected to perform well in the next couple of years, you still might be able to get a couple of companies who might actually yield you very attractive returns, which some of the other investors or other clients would not see. So those are the opportunities that you have to pick as a fund manager, taking a very active role on behalf of your clients to give them more than average returns actually.
Right. So, Indika, in your perspective, we are saying is like the market, in a market like ours, concentrating on sectors alone is very counterproductive, I think. Is that what you're trying to, you're highlighting? Because taking the market size to consideration, is that what are we to look at?
Yes, and actually the sectorization itself, the definitions also, you have to look at those also, because these sectors were defined some time back and things may have changed since those times, since they were defined. So yes, the one is the market size, the other one is the definition within the sectors themselves.
Right. So it's actually a very nice view Indika taking as well, because I think sometimes the more traditional thing is to concentrate on a sector, a couple of sectors that you expect the market to perform on and to be. But what you're saying is the managers, as yourself, would go for more of a stock picking sort of a strategy would be the right way to go.
I believe so.
Right. So, moving on from the equity market, Indika, what's your take on the money markets at the moment, Indika?
Well, the money market returns, if you compare it to more traditional banking products, have been generating actually excess returns compared to these more traditional banking products. Even currently, at NDB Wealth, we have about 3 to 4 money market products, and a couple of them are actually giving extremely attractive returns. One fund is yielding above 10% compared to a savings product which might give you 5 to 6% at best. On top of that, the mass market investor has access to a fixed deposit, a call deposit, or current account. So rather than yielding lower returns through those products, I think if you expose yourself to a new asset class through mutual funds or unit trusts, you might be able to give a boost to your overall returns in the long term, because what you have to understand is through short term higher returns, in the long term through the compounding effect, you can actually earn an extremely high return compared to investing in a more traditional savings product.
Oh, wow, okay. So, I mean, actually, I think that follows on to actually the question I was going to ask you next was actually about, for the benefit of our viewers again, what is the strategy from a fund manager's perspective? I know you touched on the unit trust already, talking about the money market, but inclusive of the unit trust, I mean, what sort of strategies would you recommend to our viewers at the moment?
Well, that depends, Ranuka. The strategy, there is no common strategy for all investors. It depends on the risk appetite of the investor, the quantum of funds the investor has. There are a few other things, the risk the investor is willing to take. So there are a few things that you have to consider before deciding on a strategy. For example, one investor might be keen on staying in the equity market. One might be a little bit more risk averse and staying in the fixed income market. So you have to closely monitor all these markets and first understand, what do I want? What's the risk I can take? How long? What's the duration I can invest this money for? So then, based on those factors, probably you can make a decision. But if you take a more mass market investor, now if you look at those investors, they have a very limited amount of instruments to invest. For example, the fixed deposits, savings deposits, the stock market. But on the other hand, if you look at a fund management company who has a unit trust fund, they run few funds which is exposed to a variety of debt instruments or money market instruments which these mass market investors don't have access to.
Right.
So instead of directly going and investing in these instruments, this mass market investor can come and invest their money in a unit trust funds,
Right.
and probably get exposed to those instruments such as probably debentures, corporate debt, things like that. Even the stock market, for example, assume a particular investor has 50,000 rupees.
Yes.
How many stocks can he buy and how many different companies can he invest in?
Yeah.
But if he goes and invests in a equity unit trust fund, a unit trust fund which invests in turn in the stock market,
Yes.
he might get exposed to a variety of companies, sectors, and the diversification that he needs to maximize his returns in the long term. And that way, actually, a better diversification, which means he can reduce his risk. At the same time, he has access to more companies and more stocks rather than going alone and investing directly by himself.
Right. So, Indika, to sum up what you said, it'll be for a more high network or an institutional client. There is different strategies they can actually take at the moment, taking into consideration the macro environment at the moment and how the market is performing. But again, like to the benefit of our viewers, more mass market or the retail client as we call them, you also suggest a strategy would be to partly invest through a unit trust where you get an exposure onto equity with I think traditionally called the growth funds, and where you get an exposure onto equity, and which is also managed by a professional like yourself, where you all take calculated measures to invest in equity, like you said earlier about stock picking, and also when you take the money market side as well, where you are traditionally exposed to more savings and fixed deposits. Whereas here, whereas a company with the pool funds will have access to a large number of instruments and they'll be going in for investment. So, so this way, your suggested strategy would be, Indika, would be to invest through unit trusts as well to gain the advantage of these the instruments. Is am I right to assume that?
Yes, they can invest through unit trust funds. For example, you have the option of going to the stock market through a growth fund, like you mentioned. The short-term liquidity can be provided through a money market fund, and if they want an intermediary duration, they have funds like pure government securities or funds which invest in fixed deposits of finance companies and banks, which are investment grade rated. And you have well-trained professionals who will try to give the investors return compared to what the investor themselves would have earned. So you can save your time. You are getting the expertise through the trained professionals, and you have the diversification within those funds as well.
So on that note, Indika, thank you very much for joining us, and I think it was quite informative to our viewers today. And thank you very much once again for taking time to see us. And thank you everybody at home for tuning in. And I hope to see you next week. And have a very good day. Bye bye.